budget and budgetary control. A quick recap of our last discussion. We define budget as a plan expressed in monetary terms. Budget is usually prepared to cover 1 year period. However, you may be required to prepare budget for a shorter period. We try to explain the purpose of budgeting. Why do companies prepare budgets? Can company run without budget? The answer is no. Company must have a defined plan. This plan must be documented. Then company must introduce money into the plan. Hence, there must be a budget. Budget is a means of translating companies' long-term plan into short-term achievable plan. We can also use budget to coordinate the activities of the various departments within an organization. This budget will ensure that all departments work together towards the same goal. Budget can also be used to communicate company's plan to all employees. We can use budget to measure performance. We now look at the terms of budget and the types of budgets. There must be a budget that provides guidance to every individual involved in the budget process. We talk about the budget, the principal budget factor. That is the factor that sets a limit to the volume and scale of operation. And we mentioned that in most cases, the sales budget is the principal budget factor. We discuss functional budgets, otherwise known as operational budgets. This budget is mostly prepared by manufacturing firms. It includes sales budgets, production budgets, raw material purchase budgets. We explain rolling budgets. Budget that is continuously updated depending on the number of periods that is defined. This budget, rolling budget, is a continuous budget, a continuous budgeting system, whereby the budget will be continuously updated at the end of a given period. If you are talking of 3-month budgets, 3-month rolling budgets, that means if you start your budget, you are going to prepare budget for the first 3 months, January, February, March. Now, when the month of January has ended, you are going to remove the January budget and update the budget with April budget. That means you now have February, March, April. This is the concept of rolling budgets. We explain zero-based budgeting, incremental budgeting, top-down budgeting, bottom-up periodic budget, activity-based budgeting. We equally explain the uncertainty in budget, that budget is prepared based on estimates and assumptions. Because we have prepared this budget based on estimates, there is the possibility of errors. Hence, there is the possibility of uncertainty in our figures. We explain how uncertainty in budget can be managed. You can prepare flexible budgets to manage budget uncertainty. You can carry out sensitivity analysis to manage the budget uncertainty. You can also carry out stress tests or probability distribution and expected value concepts, so as to manage the uncertainty in your budget. We explain financial budgets that include cash budgets, profit or loss budgets, and budgeted balance sheets. Your cash budget, these are budgets prepared that shows the cash receipts, that is the cash inflows and the cash outflows. At the end of the period, we can determine whether there is cash surplus or cash deficit. Your cash budget will enable you to determine whether you have cash surplus or cash deficit. Where there is cash surplus, management must decide on how to invest the surplus. Where there is cash deficit, management must make plan on how to cover the cash deficit. We explain profit and loss budgets, budget prepared based on Akura concepts. This budget is prepared whether we make sales. Once we make sales, whether we have received cash or not, the amount of sales must be recognized in our profit budget. Once we incur cost, whether we have paid for the cost for the expenses or not, the expense must be recognized in our income statement. We now have budgeted balance sheet. We talk about fixed budget, flexible budget, and flex budget. We try to make distinction between these three. Fixed budgets, budget prepared before the budget period, prior to the budget period. This budget is the original plan of the company. This budget is not designed to change because it is the original plan of the company. So this budget will be prepared prior to the budget period. We now have flexible budget. Flexible budget is prepared also before the budget period. It is prepared along with the fixed budget to make provision to accommodate changes in circumstances. Flexible budget is prepared. This budget can accommodate changes in circumstances. Then we now have the flex budget. The flex budget is prepared at the end of the financial year. The flex budget is prepared after we have the actual results. You are going to take your actual results, that is the actual activity level, against the budgeted cost and the budgeted revenue. You now prepare your flex budget. When you are flexing a budget, you are trying to bring in the actual outputs. You now use it against the budgeted cost. We explained this. Thereafter, we were able to solve question 1. Question 1 is on production budgets. Sorry, it's on functional budget. All right. Any questions so far? All right, we move to question number 2 is all involving question. It involves production budgets, cash budget, profit and loss budgets. Let us attempt this question. Please, let's get our calculator ready. I want to, if you're able to finish this question, it's good for us. Please, let's get our calculator ready. All right, question 2.
Do you need someone to read for you, sir?
You came to class today.
I did.
Joy, did we offend you?
No.
I was just telling myself that I've not been seeing.
It's tiredness.
Yeah, read. Thank you.
And I was sick at some point. Okay.
Let me read. Don't worry. I'll read. Relax. I'll read.
Okay.
All right. Question 2. All right. ABC is a manufacturing company which makes products Zeta. The budgeted monthly production and sales are 200,000 units. A standard cost has been estimated on the basis of direct cost of 7 naira of material, in brackets, 2 kg at 3 naira 50 kobo per kg. Now let's explain that. Direct material cost per unit is 7 naira. This is derived as 2 kg of material multiplied by the price per kg. The price per kg is 3 naira 50 kobo. If you multiply 3 naira 50 kobo by 2, that will give you 7 naira. So what we are saying here is that to produce 1 unit, you require 2 kg of raw material. And price per kg is 3 naira 50 kobo. Therefore, the material price per unit is equal to 7 naira. Please, you must be able to differentiate between cost per unit and cost per kg. Examiner will give you all this in the exam. You must know if you are dealing with units, you pick cost per unit. If you are dealing with kg, then you are going to pick cost per kg. All right? And 6 naira for wages, in brackets, half an hour at 12 naira per hour. Now look at it. Labor cost per unit is 6 naira. This is derived as half an hour at 12 naira per hour. Now, if you are to interpret this, to produce a unit, we require half an hour. And the price per hour is 12 naira. Now, please multiply half hour by 12. If you multiply half hour by 12 naira per hour, that will give you 6 naira. So labor cost per unit is 6 naira. But cost per hour is 12 naira. All right. In addition, variable overhead have been determined at 2 naira per unit. Monthly fixed overhead are 200,000 naira. Monthly sales for the first 5 months of 2025 has been estimated as, look at the monthly sales from January to May. Next, actual sales at the end of 2024 were 190,000 in November and 220,000 in December. Next paragraph. Cash receipts from sales is based on previous experience and is expected to receive 60% in the month of sales, 20% in the following months, and 10% 2 months after sales. It is expected that 5% will be irrecoverable and will be written off in the month of sales as bad debt. The selling price per unit is 18 naira. Next paragraph. Creditors for raw materials are paid at the end of the month in which they are incurred. So if you buy raw material, the same month you purchase, the same month you pay. Wages are paid the same month as incurred. Variable overhead are paid 60% in the month in which they are incurred, 40% in the following months. Fixed overhead include 25,000 naira of depreciation and are paid 1 month after the costs are incurred. At 1st January, creditors for variable and fixed overhead are estimated at 92,000 and 150,000 respectively. Next paragraph. The company intends to have finished goods at the end of each month, equivalent to 15% of the following month budgeted sales. Please note that the company intends to have finished goods at the end of each month. That means closing stock of finished goods at the end of each month is equivalent to 15% of the following month's budgeted sales. For raw material stocks, the policy is to have 25% of the following month production requirements. Stocks as at 1st January 2015 are estimated as 22,000 units of finished goods and 104,000 kg of raw material. Please, can you see the differences? Stock of finished goods, that is units. That is completed production, 22,000 units. Stock of raw material, examiner stated that in kg. All right, next item or next line. The cash balance as at 1st January 2017 is estimated at 13 naira. Requirement A to D. Produced for the months of January, February, and March 2015. Production budget in units, material purchase budget, cash budget, and budgeted profit and loss for the 3 months, totaling 30 marks. So you have to get 30 marks for it. All right. Let us move straight to our working. Please, like I said, let us get our calculator ready. We move straight. Requirement A, production budgets. Production budgets. There must be a period for your budget for 3 months. 2015. The months January, February, and March. This is the budget we are required to submit, to prepare. However, so for some reason, you are going to require a pre-budget. You are going to see the reason for a pre-budget. So I'm going to put a demarcation here, so that you know that we have just brought in April to complete our budget. The Naira sign. Oh, sorry, it's in quantity. So if you recall the format for production budget, we start with plan sales. What is the plan sales in January? Plan sales in January, February, March, April. 2015. Go back to the question. Look at it. Monthly sales for the first 5 months of 2015 has been estimated as January sales 210,000, February 180, March 210, and April 220. Please pick this figure. Let's move. We have 210. 180. Please, can we mute? And if you are not muting, please ensure that you can control the noise from your end without disturbing the class. Then April estimated sales is 220. Next, add desired closing stock plus desired closing stock. Closing stock of finished goods. Finished goods. Now, what is the policy on finished goods, closing stock? Let's go back to the question. Towards the last paragraph, look at this. The company intends to have finished stock at the end of each month, equivalent to 15% of the following month budgeted sales. That means closing stock for January is going to be 15% of budgeted sales in February, following months. Come here. Closing stock for January is equal to 15% of the following month budgeted sales. The following month after January is February. Now compute 15% of January budgeted sales and supply the figure.
Instead of January or February, the following month.
Yes, 15% of February sales.
That's 27,000.
27,000. This is closing for January. We move to February. Following month February is March. Compute 15% of March sales.
That's 1,500.
Sir,
Yes, ma'am.
please help me explain that this 15% you are doing.
All
I
right.
don't know, the thing has scatter in my eyes.
Don't let it scatter. The question says the company intends to maintain finished stock at the end of each month, equivalent to 15% of following month budgeted sales. The company intends to have finished stocks at the end of each month, equivalent, that is equal to 15% of the following month budgeted sales. Is that clear now? Now let's go to the calculation. January. Which month follow January?
February.
February. Now that means if I want to get January closing stock, I'm going to compute 15% of February budgeted sales.
If I want to get January closing stock, I'm going to compute 15% of February.
Is that clear, please?
Yes.
Is that clear? Now, if I want to get February closing stock, I will now say, okay, which month follow February? March. I will now compute 15% of March budgeted sales. Now, that will be for February. If I want to get March closing stock, which month follow March?
April.
April. I will now compute 15% of April budgeted sales.
33,000.
Thank you. 33,000. You see why we needed April now? If I want to get April closing stock, I will now look for which month follows April. Which month is following April?
May.
May. Now let's go and check May. What is budgeted sales in May?
200,000.
Now compute 15% of 200,000.
30,000.
30,000. We have gotten the closing stock. Add. Now minus opening stock of finished goods. Let's go check. Look at the note here. Stocks as at 1st January 2015 are estimated as 22,000 units. Guys, can you see it? This is opening stock in January. Is that not, please? Hello?
Yes, sir. Yes, sir.
Thank you. Our opening stock in January is 22,000 units. Minus this. Now, opening stock in February. Now look at it, please. Your closing stock in January becomes opening stock in February. 27,000. This was closing for January. It becomes opening for February. Next, your closing stock in February becomes opening stock in March. 31,500. Then your closing stock in March becomes opening stock in April. You can now do your plus minus so that you can get your budgeted production budget in units. Do your plus minus, please.
115,000 for January.
Thank you. 215,000 January. $184,500 for February.
211,500 for March.
Oh, this student is calling. Just 1 minute, please. $211,500 for March.
217,000 for April.
117.
217.
Thank you. 217,000. You are done with your production budgets. Oh, where is this person? Williams, please, you are completing the class. You are done with your production budget. We move to the next calculation. This is our production budget. Production budget in units. Next, requirement B, material purchase budget. Material purchase budget. Also for 3 months. For 3 months. Our months January, February, March, then we have to maintain April. Because of the company policy, we must introduce April. All right. Now, if you remember the format, you start with your plan production, plan production, for January is 215,000 units we are going to produce in January. February, we shall produce 184,500 units. March, we are going to produce 211,500 units. February, we plan to produce 217,000. Next, multiply by material required per unit. Multiply by material required. If you look at the question, to produce 1 unit, we require 2 kg of raw material. 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 So, total material requirements. Total material requirements. Please multiply.
430.
This is, now you know it's not kg. This is 430,000 kg. Please remember, it's no longer units. This is 430,000 kg. Next, multiply.
369,000 kg.
369,000 kg. Next.
423,000 kg.
423,000 kg. Next.
434,000 kg.
434,000 kg. So please be mindful. Total material required in January is 430,000 kg. Total material required in February, 369,000 kg. Material required in March, 423,000 kg. Next, plus is my cursor, come here, plus desire closing stock of raw material. Raw material. Now let's go back to that company policy. Look at it, please. For raw materials stock, the policy is to have 25% of the following month's production requirements. That means if I want to calculate closing stock for January, raw material, I will now check following month's requirements. Let's go back to our working. If I want to get January closing stock for raw material, examiner says 25% of following month requirements. Following month is February. Requirements following month is 369,000. So 25% of 369,000 will be closing stock for January. Please compute.
92,250.
92,250. I'll move to February. Following month after February is March. So 25% of March requirements become closing stock for February. Please compute.
105,750.
105,750. Then I will move to March. 25% of following month requirements. Please compute 25% of 434,000.
108,500.
108,500. Then I will now move down small. Less opening stock. You don't need to bother about April. Remember, April is just to complete March. I'll come here. Minus opening stock of raw material. Now let's get back to the question. Stocks as at 1st January 2015 are estimated as 22,000 units of finished goods and 104,000 kg of raw material. So opening stock in January, 104. 4,000 kg. What is opening stock in February? The same thing we did. Closing stock of raw material in January becomes opening stock in February. Pick your figure. 92,250 minus. Then next, closing stock of raw material in February becomes opening stock in March. 105,750. Now you can get material purchase budget in kg. You are going to start from total material required plus desired closing stock minus opening stock. Please, can we supply figure? Here, I've moved so far.
418,250.
418,250. 418,250. Next.
382,500.
382,500. Next.
425,750.
425,750.
425,750. This is material purchase budget in kg. Material purchase in kg. Please note, material purchase budget is prepared in kg and in naira value. You must specify the naira amount. In January, the company will purchase 418,250 kg of raw material. February, the company will purchase 382,500 kg of raw material. March, the company will purchase 425,750 kg of raw material. This is the material purchase budget in kg. What is the naira amount?
3 naira 50 kobo.
Thank you. Price per kg of raw material is 3 naira 50 kobo. Now come here. Material price per kg is equal to 3 naira 50 kobo, 3 naira 50 kobo, 3 naira 50 kobo. We can now multiply to get the value. Oh, yeah, it's too much now. What happened? All right, multiply the two value.
For March, 1,490,125.
March 1,490,125.
125.
For February, 1,326,750. 38,750 for February.
387.
338,750.
338, sorry, 338.
Oh, sorry. Okay. 338
750.
750. Then for January,
1,463,875.
463.
875.
875.
Okay, 875. Eight, 7, 5. This is material purchase value in brackets Naira. You are done with requirements B. We now move to requirement C. The beauty of this question is that you can get 30-30, and the risk is that the person can also score 0. Make sure you don't fail production budgets, because your production budget material purchase budget will have impact on your cash budget. So make sure there's no error in the first budget. All right, we move on to C part of this question. We have to prepare cash budgets for 3 months. Requirement C, cash budgets for 3 months period. We have the month, January, February, and March. Our Naira sign,
Government. Music beginning one. Music beginning.
cash inflows, against cash outflow. Please, please, this person, Mr. Yusuf, please, your voice is disturbing us.
Sorry, sir.
Your cash outflows. All right, let's go to the question. For cash budget, now pay attention to cash receipts and cash payments. Of course, your cash receipt will come from your sales. That is where you are going to have cash inflows. If you make sales, we must collect money now. So let's go to look at the third paragraph. Cash received from the sales is based on previous experience and is expected to be 60% in the month of sales, 25% in the month following sales, and 10% 2 months after sales. 5% will be irrecoverable and will be written off as bad debt in the month of sales. The selling price per unit is 18 naira. So we can now look at collections. Let us go to the work. That means if you make sales, in the month of sales, you are going to get 60% cash. Month following sales. So if we make sales in January, we get 60% in January. 25% month following sales. Which month follow January? February. We are going to get 25% in February. Then 10% 2 months after sales. So 2 months after January is March. We get it in March. So we are going to deal with collection now. Let us go to our workings. Okay. I hope this space is enough, right? You can come here now. In 1, analysis. Analysis of sales. And collections. We have months. For some reason, we need to bring in 2014. 2014, we have November 2014, December 2014. We are going to require these two. Then 2015. We have January, February, and March. Because of the collection process. Now let's check the question. Sales in units. Sales in units. For November, how much? Look at it. Actual sales at the end of 2014 were 190 units in November and 220 in December. Okay, I'll pick this figure first. Quantity sold in November, 190,000. December, 220,000. Budgeted sales in January, 210.
Sir,
February, 180. March 210.
Sir,
Yes, please.
this is a quick question. We are picking November, or I just want to confirm, we're picking November because the the payables would flow into January, February, March. Is that why we are doing this?
Correct. Because the collection will flow to January, February, March.
Sorry, collections, not payable.
Yes, the collection will flow to January, February,
Okay.
March.
But if they had not given us November and December, we will just start from January.
That means the collection will not be stated in that way.
Okay. Okay, not a problem then. Thank you very much, sir.
You're welcome, please. Now, selling price per unit. Sales price per unit is 18 naira. Is that not, please? Is that not, please?
Yes, sir.
So guess sales value for January. For November, sales value 18 naira multiplied by 190,000. How much?
3,420,000.
3,420,000. Assuming 30 up, this will give us our sales value. Let me move down a bit. Our sales value. Our sales value for November, that becomes 3,420,000. Is that not?
Yes, sir.
For December, multiply 220 by 18. What do you have?
3,960.
960. Value for January, multiply by 18.
3,780.
3,780. Assuming 30 up. Value for February, multiply by 18.
3,240.
Then value for March, multiply by 18. Okay. These are the sales value, revenue. For November revenue, December revenue, January, February, March. Now let us look at the collection. How are we going to collect the cash? In December, huh? Just 1 minute. Please, just 1 minute. Now come to collection. Collection pattern. Examiners say 60% month of sales. 25% following month. This one is too much far. Just take it easy. 25% following month. 10% 2 months after. Now let us collect for just 1 minute. Please, just 1 minute. Let's go on, please. Now we are going to start with November collections. When we are done with November collection, we move to December collection. Now let's start for November collection. November, we made a sales of 3,420,000. We are going to collect 60% the same month. Please compose 60% of 3,420. What do you have?
2,052.
2,052. This amount will be collected in November. Then we move to January. We move to December, month following November. 25% of November sales to be collected following month. Please compute. Following month, that will become December.
990.
990 to be collected in December. Then 10% of November sales to be collected 2 months after. 2 months after we take us to January. Please compose.
Hello, sir.
Please speak.
This 25%, the following month, we will take 25% of the 3,420, which is November sales.
Yeah, to be collected following months.
Okay, so the figure is 855, not 990.
Oh, thank you. Somebody went to compute wrongly now.
Please, sir, can you start again? Can you start again? How do you get the 2,052 naira? Hello, sir.
There was a network glitch there. All right, let's get back to it. Now we are dealing with November sales. In November, we made a sales of 3,420. Now, how do we collect our cash? Examiner says 60% to be collected month of sales. So compose 60% of 3,420. What do you have?
Okay, 2,052 naira.
You are going to collect it the same November. You know, you observe that I place it under November. Now, 25% of November sales to be collected in December following month. Compute 25% of 3,420.
855 naira.
This amount will be collected following month. Following month is December. You observe that it was placed under December. Then 10% of November sales to be collected 2 months after. Please compute 10% of 3,420.
342 naira.
You observe that we place it in January, 2 months after. We made this sales in November, but we are collecting the cash in January. Is that clear, please? We now move to December sales. In December, we made a sales of 3,960. We are going to collect 60% of this money in December, the same month. Please compose 60% of 3,960.
2376.
2376. Now, 25% of December sales to be collected following months. Following month is January. Please compute 25% of 3,960.
990.
990. 10% of December sales to be collected 2 months after. That will take us to February. We are done with December. I will now come to January. In January, we made a sales of 3,780. 60% to be collected in January.
2268.
2268. 25% of January sales to be collected the following month.
945.
945. 10% to be collected 2 months later.
378.
That will be collected in March. We move to February sales. In February, we made a sales of 3,420. 240. 60% to be collected month of sales.
1944.
1944. Collected month of sales. 25% to be collected following month.
810.
Following month after February is March, 810. 10% to be collected 2 months later. That will give us 342 to be collected
324.
in February, in April. We are not interested in April budget. We move to March. 60% of March sales collected in March.
2268.
Others will fall aside this. Is that not?
Yes, sir.
You don't need to waste time doing others again. 2268. Your attention will only be in the 3 months. Look at the 3 months. January, February, March. You now start from your collection. It's collection you are going to add. Oh. You are going to add only the collections. Please add 2268 plus 990 plus 342. What do you have here?
3600.
3,600. Next.
3285.
3285. Next.
3456.
3456.
3456. You have gotten your cash receipts. Move back to your budget. Under cash inflow, that's it. Put sales receipts. $3,600,000. 3,285,000. Here we have 3,456,000. You have picked your inflow. We now move to outflow. Look at the next paragraph. Creditors for raw materials are paid at the end of the month in which they are incurred. Go to your, that means raw materials are paid for. The same month they are incurred. So let's go to it. Go to your material budget. Look at it. In the month of January, we are going to incur 1,463,875 for raw material purchase. That same month, we are going to pay it. Creditors for raw materials are paid. The same month, the raw material cost is incurred. So you are going to pick all these values. 1, 2, 3. Payment for raw material. That's an outflow. You come here. Payments for material. 1,463,875. 463,875. Then in February, 1,338,500.
750. 750.
750. Then in March, we have 1,000,000.
190,125.
1,490,125.
125.
So raw materials are paid for the same month they are purchased. Next, Payment for wages. No, you are moving too fast. Okay, you can use this place. Payments for wages. Let us look at the note on wages. Look at it also. Wages are paid the same month as incurred. Now let's go to it. Working number 2. Working 2. Labor wages. We have January, February, and March. In the month of January, if you check the production budget, we are going to produce 215,000 units. In the month of February, we are going to produce 184,500 units. In the month of March, we are going to produce 211,500 units. The question says, wages per unit, labor cost per unit is 6 naira. Multiply by 6 naira. Labor cost per unit is 6 naira. Let me show you in the question. Look at it. A standard cost has been estimated on the basis of direct cost of 7 naira for material, in bracket 2 kg multiply as 350 per kg, and 6 naira for wages. That 6 naira is per hour, per unit. In brackets, half an hour to produce a unit, and the rate per hour is 12 naira. So labor cost per unit is 6 naira. So we are going to produce 215 in January. Please compute total labor cost.
1,290,000.
1,290,000. Next.
1,107,000.
1,107,000. Next.
1,269,000.
1,269,000. Examiner says wages are paid for the same months as incurred. So these figures will be paid for immediately. In the first month, 1,290,000. Second month, 1,107,000. Third month, 1 million how much?
269.
269,000. That is payment for wages. We now move to the next item. The next item. Look at this. Variable overheads are paid 60% in the months in which they are incurred, and 40% in the following months. Just 1 minute, please. All right, let's move on to this. So let us go and compute variable overhead incurred. Don't forget, variable overhead per unit is here. In addition, variable overhead have been determined at 2 naira per unit. So, working number 3, variable overhead. Wow. It's okay. Variable overhead incurred Please remember, your cost will be based on production. January, we are going to produce
Hello, sir. I don't know if I'm the only one. No, I can't hear you.
Same here.
And he's talking. Oh, can anybody hear him, please?
Hello, sir. We can't hear you.
Sorry, please. Is the class still on?
The class is
Abi,
on.
is it
I
just
think he
me?
has network issues.
Can you hear me now?
Yes,
Good
sir.
evening,
Yes, sir.
guys.
Don't know what. You can hear me now, Abi?
Yes, sir.
Okay, is it from? Oh, okay.
I was wondering why when you say you can't hear me, I was like, ah. All right, let's go on. We are on variable overhead analysis. Variable overhead incurred in the month of January. January, we are going to produce 215,000. Variable overhead cost per unit is 2 naira. So 250 multiplied by 2 naira, that gives us 430. February, we are going to produce 184,500. Multiplied by 2 naira per unit, 369,000. March, we are going to produce 211,500. Multiplied by 2 naira variable overhead cost, that gives us 423,000. These are the overhead incurred. Now, working number 4, analysis of variable overhead payment. You know, in cash budget, it is the payments, actual payments that concerns us. Although we incurred 430,000 in January, what is the payment policy? If you go back to the question says, variable overheads are paid 60% in the month in which they are incurred, 40% in the following month. So let us go and do the analysis for payments. All right, in January, we have the months January, February, and March. In January, we incurred 430,000, but we are only going to pay 60%. Payments pattern. %60 in the month incurred, 60% months incurred, 40% following
Sorry,
Wow.
am I the one that cannot hear?
Can you hear? I can hear you, Joy.
Okay, so I wasn't seeing anything and I wasn't hearing.
I said compute 60% of January overhead incurred.
258,000.
258,000 to be paid in January. Then balance of 40% to be paid following month.
172,000.
172,000. You observe that following month after January is February. I will now go to February. Amounts incurred in February, 369,000. 60% of this amount will be paid in February. Please compute.
221,400.
221,400.
221,400 to be paid in February. Balance paid following month after February. 40%.
147,600.
147,600. Now, when we get to 1,000, 60% to be paid in March.
253,800.
253,800.
253,800. Balance to be paid when?
April.
In April.
Thank you. But we are not dealing with April budget here. Now we are not done. Examiner says, look at these notes here. At 1st January 2015, creditors for variable and fixed overhead are estimated at 92,000 for variable, 150,000 for fixed. That means as at open of January, we have variable overhead incurred in December that will be paid in January. The amount is 92,000. You now bring this here. We bring this figure here now. Opening balance for January, 92,000. This amount was incurred in December 2014. But the balance will be paid in January. Is that clear, please?
Yes, sir.
You can now get your,
No, sir, I don't understand.
which one now?
What you just said now, the balance, the opening balance.
Okay, if you look at that question, please look at this. At 1st January 2015, creditors for variable and fixed overhead are estimated at 92,000 and 150,000 respectively. It means that the creditors for variable overhead are 92,000 naira. That was the opening stock, sorry, opening value of variable overhead. It was closing for December. It becomes opening for January. This amount was incurred in December 2014, but will be paid in January 2015. Is that better, please?
Yes, sir. Thank you, sir.
So you can now add payments, add.
350 for
This is
January.
350,000 to be paid. Variable overhead, add, what do you have?
393,400.
393,400.
393,400. Next,
401,400.
401,400.
401,400. You can now go back to your cash budget. Payment for overhead, for variable overhead, we have to specify it. Okay, we'll take it small. We come here. Payments for variable overhead. 350,000 in January, 393,400 in February, and how much in March?
401,400.
401,400.
401,400. Then we now move to payment for fixed overhead. Payments for fixed overhead. All right, let's go back to the question. If you look at the start of the question, examiner says annual fixed overhead, monthly fixed overhead are 200,000 naira. Note that. Also come and overhead in and are paid 1 month after the cost has been incurred. That means overhead costs are paid 1 month after incurred. The overhead costs incurred in January will be paid in February, 1 month after incurred. The overhead costs incurred in February will be paid in March. Overhead costs incurred in December 2014 will be paid in January. Examiner say this overhead Please, can you hear me?
Yes, sir.
The frequency is too much. Oh. I was trying to explain fixed overhead. Monthly fixed overhead is 200,000, but there's depreciation included in that overhead. Depreciation figure 25,000. Depreciation is a non-cash flow. So we have to remove that depreciation. We come here, working 5. Working 5. Monthly fixed overhead. Examiner say this is 200,000 less depreciation. You don't include depreciation in your budget. Less 25,000. That means our monthly cash fixed overhead, monthly cash fixed overhead. The overhead cost incurred in the month of January. Examiner say this will be paid following months, 1 month after. So if I come here now, overhead cost, fixed overhead for January to be paid in February, 175,000. The fixed overhead cost for February to be paid 1 month after, that will be March, 175,000. Now the fixed overhead cost to be paid in January. Let's go look at the question. Look at it, please. As at 1st January, creditors for variable and fixed overhead are estimated at the fixed overhead cost is 150,000. Creditors we are supposed to pay. Of course, we don't pay depreciation. So we are going to pay these amounts. 150,000 opening fixed overhead creditors to be paid in January. These are all the cash inflows and cash outflows. You can now sum up your, get your total outflow. Total cash outflow. You are going to add from material purchase. Let me shift a bit up. From material purchase plus wages plus variable overhead plus fixed overhead. Please let us sum this.
For January, 3253,875.
For February, 3,014,150 naira. Hello, sir.
Now, wow, this thing is disturbing my class. So I hope you can hear me, guys.
We can hear you,
Yes.
sir.
Yeah, please, let's share some. What can we do now? MTN is behaving somehow tonight, though. Yes, any answer ready?
For January,
For
3253875.
January 3, 2, 5,
3,
3,
875.
8, 7, 5.
for
Next,
February 3014
3014
150.
150.
3
For
million
March,
335
3,335,525.
525.
All right. You can get your net cash flow now. Your net cash flow is cash inflow minus cash outflow. Net cash flow. Let's move a bit up. Cash inflow in January, 3.6 million. Less 3,253,875. What do you have?
346125.
346125.
3, 4, 3 for what?
346125.
346.
1, 2, 5. Next, for February,
270,850.
270,850. For March,
120,475.
120,
475.
475. You now introduce opening cash balance. Opening cash balance. If you look at the question, examiner says the cash balance as at 1st January 2015 is estimated at 13,000. Now come here, plus 13,000. This will now give you closing. Please permit me to move this a bit. I require this space here. Okay. I can now get my closing cash balance. Please add these two.
359,125.
359,125. This is closing cash for January. It becomes opening for February. 359,125. Please add the two for February to get closing for February. 270.
629.
Just one. Let me push a bit. Let me push a bit up. That's not too much. Okay. 629.
975.
575.
975. 975.
Okay. 975. This is the closing figure for February. It becomes opening for March. 629, 975. Now add for March.
750.
750.
450.
450. You are now done with your cash budget. This analysis of sales. Analysis of sales. All right. We have just finished C. The last one is now the production budget. So the last one is now the profit or loss budget. We have like 20 minutes. Remember profit or loss budget. Your sales will be recognized once sold, whether we collect cash or not. And expenses will be recognized once incurred, whether we make payments or not. Remember, our profit or loss budget is based on Akura concepts. All right, let us drive this part with the profit and loss budget. Requirements D. Please, if you are looking at after the class, we are going to share the working notes. It's better to look at it from the desktop, not your phone. If you can take it to your laptop or you have a desktop, it will be clearer on your desktop. So, profit or loss budget for 3 months. For 3 months, ending March 2015. You have the month, January, February, March, then we have the total. Of course, if I'm doing profit and loss budget, I must pick my sales value. What is the sales value for January, February, March? What is the sales value for January, February, March?
For
Yes.
January, 3,780.
Okay, we can
3,780,000.
shorten this. 3,780. February, how much?
3,240.
3,240. March, how much?
3,780.
Yeah, thank you. That means you are following now. Total sales for the end of March, please sum. The total sales as at the end of March, sum January, February, and March.
10,800.
10,800, thank you. 30 up. Now, examiner says bad debt. 5% of sales will be recoverable and is taken as bad debt. Bad debt will affect our income statement. Now come here. Bad debt, 5%. Please compute 5% of January sales. That will give you 189. 5% of February sales. That should give you 162. 189. Total bad debt, 540. We are going to deduct this. Get your net sales. Net sales. How much?
3,591.
How much do I have here?
3078.
3078. Total. How much do we have here? 10,260.
Yes, sir.
All right. We come to our cost. This is our sales. Our cost. We start with material cost. Material used. Not material purchased. It is only the material purchase is different from material used. Material used for production. What is the cost of material used for production? we know cost of material purchase, but not all material purchase will be used for production. So what is the cost of material used for production? Let's come here. Go to your material budget. Look at the budget. Material required for production. In the month of January, the material required for production is 430,000. In the month of February, material required for production 396,000 kg. In the month of March, material required for production for 23,000 kg. These are the material used. Now find the cost. To do this, you are going to multiply 430,000 kg multiplied by material price per kg. Material price per kg is 3 naira 50 kobo. So multiply 430 by 3 naira 50 kobo.
1,505,000.
1,505,000. Okay. Let's go now. Cost of material use. $1,505,000. For February, 369,000 kg multiplied by 3 naira 50 kobo.
1291.5.
1291.5. Thank you. For February, we are going to use 423,000 kg multiplied by material cost per kg.
1,480.5.
1,480.5. Now sum total material usage cost.
4,277.
What do you have?
4,277.
4,277. In exam, please. If you are doing profit and loss budget, there is difference between material purchase cost and material usage cost. It is only the material used for production that will go to my P&L. Now we come to labor cost. Labor cost. This one we can pick because labor cost is the same. Labor cost incurred is the same as labor cost for our P&L. Look at it. Labor cost incurred, where is it?
1290.
Yeah, thank you. I just want to show the class. Look at labor wages. 1,290,000, 1,107,000, 1,269,000. This is your labor cost. I'll come here. 1,290,000, 1,107,000, 1,269.0.0. Please sum total.
3666.
3666. We move to variable overhead. Variable overhead incurred, whether paid for or not, we must take it in. Go to working 4 or working 3. Look at it. Variable overhead incurred 430,000 naira, 369,000, 423,000. Pick the figure. Under profit and loss, once the cost is incurred, we have to take it. 430, 369. Then what do you have here?
423.
Totaling how much? So
1222.
1222. Then our fixed overhead incurred. Monthly fixed overhead is 200, including depreciation. Under P&L, we don't remove depreciation. Depreciation is part of the cost incurred. 200,000 incurred in January, 200,000 incurred in February, 200,000 incurred in March, totaling 600,000. You can now get your total cost here, total cost here, total cost here. Also get total cost. This is called manufacturing cost. Total manufacturing. Please, let's sum from material cost down to fixed overhead, manufacturing.
For February, 2,967.5.
For February 2009, 967.5. Next.
For January,
March.
3425.
3425. Next.
For March, 218.5.
2184.
No, 3,372.5.
3,000.
372.5.
3,372.5. Then sum total here, what do you have?
9765.
9765. You can close this, but don't close this. Your total manufacturing cost at the end of March is 9,765,000. This is the manufacturing cost. We now introduce opening finished goods and closing finished goods. Opening stock of finished goods. This is plus, then minus closing stock of finished goods. If you go back to the question, examiner says stocks, please note there is difference between stock of raw material and finished goods. you observe that when we get to material, we only pick cost of material used. So we didn't say material purchase, material used. So we don't require opening stock of material or closing stock of material because we only picked material used for production. Now, examiner says stocks as at 1st January 2015. The stock of finished goods is equal to 22,000 units. I'll pick this. Stock of finished goods, 22,000 units. This is the units. As at opening January. What is closing stock as at ending March? Remember, the profit is for ending March. Go to your production budget. That will tell you. Look at it now, budget. Look at closing stock of finished goods, March, 33,000 units. I'll pick this figure. $33,000 units. We now need to value this now. It is the value now. We value this stock. Now to value this, we now come to the question again. Look at paragraph 1. Examiner says a standard cost has been estimated on the basis of direct cost of 7 naira for material. So please note, material cost per unit 7 naira, labor cost per unit, wages 6 naira, and variable overhead determined at 2 naira. Please add 7 naira plus 6 naira plus 2 naira. What do you have?
15 naira.
That is our variable cost per unit. Material is a variable cost. Labor is a variable cost. Variable overhead is variable cost. Variable cost per unit is 15 naira. Monthly fees overhead is 200,000. But whether we produce or not, your stock will only be valued using variable items. Whether we produce or not, the fixed cost remains fixed. The fixed cost is not affected by volume of production. So if you are going to value this stock, you are going to value this stock using at 15 naira per unit. At 15 naira per unit. Get your opening stock value. Take it to the last total.
330.
How much?
330.
Our opening stock value 330. We are going to add. Closing stock value, how much?
495.
Our closing stock, we are going to less. Remember when you are doing your income statement, profit and loss statement, you have opening stock plus purchases minus closing stock. That will give you your cost of goods sold. Is that not, please?
Yes, sir.
If you remember your profit and loss account, say, we have our opening stock plus purchases. In this case, we didn't purchase, we manufacture. The manufacturing cost is 9,765. So our cost of goods sold, let me round up. I have just 1 minute. Cost of goods sold. Please add 9,765 plus 330 minus 495.
9,600.
Our cost of goods sold is 960. Let me just extend small. Therefore, our profit. Your profit is your sales, net sales minus cost of goods sold. Your gross profit. Place minus 10,260 minus 96. What do you have?
660.
That is the profit. 6. You are done with your P&L. This will give you your 30 marks. This question is like 2 questions from production budget to cash budget to profit and loss budget. It's exactly 11 o'clock. We are done with the question. Please, may God give us a better understanding. It is advisable that you try to do this question again as quickly as possible. If you can create time tomorrow, try to solve it. All right,
But
any question?
can we get the video as soon as possible?
By the standard of the school, the video should be out latest tomorrow. It's only when there's the video should be out, should be available for your watching by tomorrow evening.
So I will appreciate that.
All right. Let's have a blessed evening. Good night.
Please, sir, for that variable overhead, what do we use to multiply it?
Variable overhead.
Yes.
Oh, we have done it before. Look at it. Look at it. We just pick it. Look at working three. Variable overhead incurred. Can you see it?
Okay. I think there's one that we multiply with Naira.
Yes, that was our material used.
Okay,
look at the
okay. Yes.
material.
What do we use to multiply it?
Okay, you know the material cost per kg is 3 naira 50 kobo.
Yes,
So
sir.
when you get to your material, it's because of space. I will even show the working anyway. When you get to your material usage, look at the material usage. Look at it. Total material required for January 430,000 kg. February 369,000. So for January, you are going to multiply 430,000 multiplied by 3 naira 50 kobo.
Okay.
February multiplied by 369,000 multiplied by 350 kobo. Then March multiplied by 423,000 multiplied by 350 kobo. That will give you cost of material used. Is that clear? Is that clear, please?
Yes, sir. Thank you, sir.
All right, let's have a blessed evening.
Good night, sir.
Yeah, good night.
Okay, bye-bye.